Hi, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome back to our Beginner's Corner Information Series, second edition. Today, we're going to be going through Lesson 7, Exit Strategies for Position Management. You'll recall there are three required skills for mastering the strategy of covered call writing. First, stock selection, then option selection, and now position management. Now, Lesson 7 is going to give you an overview of all the exit strategy opportunities we have. The details are found in my books and DVD programs, but I do want to give you an idea of the amount of control we have with our covered call positions in terms of mitigating losses and enhancing gains. Now, what I do is I take a look at the events that may cause us to execute an exit strategy. When might these opportunities arise? And they fall into four categories. Number one, the price of the stock declines. That, of course, is the enemy for covered call writers. What do we do? How can we mitigate, and can we turn losses into gains? And the answer is that we could do plenty, and sometimes, yes, we can turn losses into gains. What if the price of the stock rises substantially? Can we make even more money than a maximum return? Once again, the answer is yes. What if it's expiration Friday or around expiration Friday? The strike is in the money. We don't want to give up our shares. Or we may feel like it benefit us to use them again in the next month. Can we avoid assignment? Once again, yes, we can. And finally, avoiding dividend X dates is a way of avoiding early assignment, because dividend X dates is the main reason for early assignment. And how we do that is detailed again in my books and DVDs. So I divide up exit strategy opportunities into two time frames. First, prior to expiration Friday, or in the first half of the contract, and later on we'll be getting into on or near expiration Friday exit strategies. And these strategies include rolling down, which is buying back the current option and selling another one at a lower strike price. Hitting a double, which is buying back the current option, waiting for the price of the stock to rebound, and then sell the same option a second time. Unwinding the total position, I call that the mid-contract unwind exit strategy, when share price goes very high and we're looking to generate more than a maximum return. Converting dead money to cash profits, which means closing both legs of the trade, okay, buying back the option and then selling the stock when the stock is just not cooperating and we've just had it with the stock. And that can be executed at any time during the contract. All these exit strategies start out the same way, by buying back the option. So we sold the option, sell to open, and now we buy back the option, buy to close. Once again, we do this in two time frames. The first half of the contract prior to expiration Friday, and on or near expiration Friday when the strike price is in the money. Now, it's important to have a look at the chart of an option's time value, because as you could see, it's not linear, it's not in a straight line, but rather logarithmic in nature. So at the beginning of the contract, the time value of an option starts to erode away very slowly. But in the latter part of the contract, it falls off a cliff. So where are the opportunities to get additional time value credit? It's in the yellow field, not so much in the brown field. So when you think about time value erosion of an option, you can use the analogy of buying a new car and pulling it out of the showroom. Right away, it starts losing money. As time goes on, it continues to lose money faster and faster. Now, because of the chart and the nature of time value erosion, that will dictate when we should buy back the option. I'm willing to spend more money in the yellow field than I am in the brown field. So I'm willing to buy back the option for 20% of what I generated when the premium was sold in the first half of the contract, but I'm only willing to spend 10% in the second half of the contract. So had we sold the option for $2, I'm willing to buy it back at 40 cents or lower in the first half of the contract, but I'm only willing to spend 20% or lower in the second half of the contract. And we can actually automate this. Once we sell the option for $2, we can immediately execute an instruction to our broker to buy it back at 40 cents and then change it to 20 cents in the second half of the contract. And so that will tell us when to buy back the option. Now, hitting a double is a strategy where we sell the option. As you could see, it was sold with the price of the stock uptrending over here. But then, despite all our screening, it goes down in price. It can happen. But because it's going down in price, the original premium of $2 also starts going down, and we can actually buy it back for 40 cents in this hypothetical, 20% of $2. Since it's early in the contract, we wait to see if the price rebounds, and in this hypothetical it did, and we're able to sell the same option for $1. So if we took that initial $2 and put it aside for a moment, the two steps we executed after that was a credit of $1 over here and a debit of 40 cents. So we had a net credit of $60 per contract, less some small trading commissions. 5 contracts, that's $300. So that's additional cash in our pocket for being prepared with this particular hitting a double exit strategy. Now, when we roll down, that's more of a bearish situation. We usually do this in the latter part of the contract. But the scenario here is, and this is a specific real-life example, World Wrestling Entertainment, ticker WWE, was bought over here at 100, and the 100 strike, I'm sorry, it was bought at 96.73, and the 100 strike was sold at $1.74. About a 1.8% 1-month return. What happens? Price of the stock goes down, and using the 20% guideline, we bought it back for 35 cents. Now, we were waiting to hit a double, but that didn't happen, folks. It kept going down. So we went to plan B, which was rolling down to the 85 strike, which generated $1.10. So this is a losing trade, but by rolling down, we got an additional credit of 110 minus 35, or $75 per contract. Nobody likes to lose money, but everybody, if they're going to lose money, likes to lose less money. And that's what rolling down will do for us. Now, converting dead money to cash profits means we've had it with the stock. It's underperforming. It didn't do what we anticipated. Over here, O'Reilly Automotive, ticker ORLY, was outperforming the S&P significantly. Now, had we entered a covered call trade at that point in time, it really looked like a good candidate. But what happens? It starts going down, and it goes down much quicker than the S&P 500. So it's underperforming the market substantially. That would be a situation where we may just say, you know what? I'm going to cut my losses. I'll realize my loss, but I'll take the cash from the sale of ORLY, enter a new position, and start to mitigate those losses. There comes a time when we just have to say, I'm losing on this particular trade, but I don't want to continue to lose. Let me move on to a better performer. Now, although we're talking about all these different exit strategies, most of the time we won't need any of them. Taking no action is probably the most common thing to do after we enter a trade. And when there's no reason to execute an exit strategy, we simply don't. In the latter part of the contract, there's very little chance to benefit because of that time value erosion graph that I showed you before. So frequently taking no action is the best thing to do in a situation, particularly in the latter part of a contract. Now I'm going to talk to you about probably the most complicated of the first half contract exit strategies, which I call the mid-contract unwind, or MCU exit strategy. And this is where the price of the stock goes up significantly. So let's have a look at this real life example here where I bought Thor Industries, THO, at 100 and sold the at the money 100 strike, generating $3. 3% initial 1 month time value return. What happens? Thor goes to the moon. 2 weeks later, it's 108.64, leaving the strike price $8.64 in the money. Now, what would it cost us to close? Well, at the time, the bid-ask spread was $6.30 to $9. So let's use $9 as the example. Is it really costing us $9? I'm going to make a case that it isn't. When we sold the 100 strike, we generated a 1 month 3% return. Very nice. But we're willing to let our shares go for 100. They cannot be worth more than 100 with that $100 strike in place. That is what our shares are worth, 100. If we bought back the 100 strike for $9, yes, we're spending $9, but now our shares are not restricted in value by that 100 strike, so they're actually worth 108.64. So we have a debit of 9 on the option side, but we have a credit of 8.64 on the stock side. So net, we have a debit of only 36 cents per share. What about stocks that gap down? So unexpected bad news comes out, and it causes the price to move down such that it goes from one point to the other where there's no actual trading in between. It's a gap down. Most common cause for gap downs is earnings, and we're avoiding earnings, so that won't cause. But bad news can rear its ugly head really at any time. So we go to finviz.com or any reliable news resource on stocks, and we look for the reason. If it's not egregious, let's say it's just one analyst downgrade or something like that, we may want to hold on to it. We're still bullish on the stock. We take a look. After the gap down, what happened? Did the price stabilize, or is it continuing to go down? If it is, we may want to just cut our losses. If it's starting to move sideways, if it's moving in lockstep with the S&P 500 or even doing better, we may want to hang on to it. So we roll down to a lower strike, but that strike, if we're still bullish on the stock, should be out of the money, so we could benefit both from option premium and share appreciation from current market value up to the strike price. So we sell out of the money call options, and we do that by buying back the current option and rolling down to an out of the money strike. Just to show you an example of what a gap down looks like, you could see here that Blue Coat Systems went from 29 to 22, and we looked at it, we still liked it, so we rolled down to the 25 strike, and we just kept doing that, avoiding earnings reports. We still managed to mitigate a lot of those losses. So again, when there's a gap down, we still like the underlying security. After evaluating the cause of the gap down, we can roll down to out of the money strikes. Okay, so that was the first time frame in the first half of the contract. Now, in the latter part of the contract, we have situations where the strike might be in the money, lower than current market value, and we still want to hang on to our stock. Still can generate good income for us in the next month. We make sure that, of course, that there's no earnings report coming out, because we never sell an option with an upcoming earnings report. So we have a look at our possibilities here, and one of them is rolling out, and that's, for example, we buy back the November 50 and sell the December 60. So we're just going out, but we're using the same strike. Now we can also roll out and up, and an example of that is we go from the November 50 to the December 55. So we're rolling out from November to December, and we're rolling up from the 50 to the 55. Again, make sure the stock still meets our system criteria, specifically no earnings report, and all exit strategies begin by buying back the option. Let's look at an example. Over here, we're going to roll the option with Biotelemetry, ticker BEAT, which I bought at 33.63, sold the out of the money 34 strike for $1.67. What happens at expiration as it's approaching? Price of the stock was up to 36.65, 265 higher than the strike price. So if we wanted to hang on to the shares, we would have to buy back that option. Now the cost to close is 310. That makes sense because of that 310, 265 is intrinsic value. That's the amount the 34 strike is lower than the 36.65, right? So that leaves 45 cents of time value. So 310 makes sense. Now it's going to cost us 310 to close. How much are we going to generate by selling the next month's 34 strike or rolling out? Well, the option chain told us 340. So right off the bat, we see we're only generating a net credit of 30 cents on a stock that's worth 34. That's less than 1%. We're probably not going to do it, but we'll run the math. The other choice is not to roll out to the 50 strike, but to roll out and up to the 37 strike. That's out of the money compared to the current market value of 36.65. That generates $1.50. Well, on first glance, we're saying, wait a minute, we're spending $3.10 to close, and we're generating $1.50 to open the next month's option. We're losing $1.60. Well, we are losing $1.60 on the option side, but let's have a look at the stock side now. When we have that 34 strike in place, that's the most our shares can be worth. When we buy back the 34 call, our share value now moves up to current market value, 36.65. So we're gaining 265 in share value. All right, what do? Well, let's feed that into the Elman calculator, and specifically the What Now tab. And let's first look at rolling out. So when we're rolling out, we know we're just going from the same strike in 1 month to the same strike the next month, the 34 strike in this case. Now remember I said we had a net credit of $30 per contract, which is less than 1%, 0.88%. We're probably not going to do that. What about rolling out and up? Well, we have a loss on the options side of $1.60. But we have an unrealized gain on the stock side of $2.65. Because with the strike in place, our shares are only worth 34. But now they're worth current market value of 36.65. So we're plus 265 on the stock side. We're minus 160 on the option side. So our net return without the stock moving up to the strike is 309. If it moves up to the strike, it's 4.12, 1 month return. So in this particular case, I would give no consideration to rolling out to the 34 strike. But if I really like the stock, I would give serious consideration to you rolling out and up to the 37 strike. Let's summarize. Exit strategies are essential to maximize profit. It is the third required skill. It is what's going to separate us from all other covered call writers. We must be prepared to take advantage of all exit strategy opportunities, whether it's in the first half or in the latter part of a contract. Using the 20%, 10% guidelines for declining stocks is critical, and we can even automate that process. And that takes care of position management lesson 7. In the next lesson, we're going to put it all together. We're going to review the entire step-by-step process for mastering covered call writing, and I will highlight for you other resources that you can use that will go into the details that will help you become an elite covered call writer. So I hope you enjoyed lesson 7. It's so important in using the strategy of covered call writing. So I hope you enjoyed it, and of course, most importantly, I hope you benefit from it. So as always, this is Alan Elman, the Blue Collar Investor. Take care, everybody.